Good afternoon, everybody. We've got a slightly different format for you now. We've got a truncated Oxford-style debate, for those who know it, know that style, on will credit or equity dominate the modern portfolio. The world of capital allocation is changing fast. Private credit has exploded, as June was saying, forecast to reach nearly 2.6 trillion globally by 2029, offering consistent income and downside protection. At the same time, equities remain in the main engine for long-term growth. And I was looking last night, the S&P 500 is up 18%, something like that this year, driven almost entirely by the tech 7 titans, but nevertheless. So in this new era where growth is uncertain, where the context is uncertain, capital is expensive, volatility high, and technology transformative, should investors prioritize credit or equity? Arguing their cases, we have Katie Koch, President and CEO of TCW Group, and Kathy Wood, Founder and CEO of ARK Investment. You have a poll for you to answer that question. And we're going to begin with short opening statements from each speaker, followed by a bit of a discussion by closed statements, and then we will see the results. So I think we agreed, Kathy, that you were going to start?
Sure.
So you have 2 minutes. Why does equity dominate?
Well, we believe that we are in a technological revolution. The world really, as we know it, has not changed in 125 years since the last technology revolution: telephone, electricity, internal combustion engine. The world has grown 3%. The real GDP has grown 3% at an annual rate over the last 25 years. We believe this technology revolution, robotics, energy storage, artificial intelligence, blockchain technology, multi-omic sequencing, those 5 major innovation platforms involving 15 different technologies that are converging. They are converging and will accelerate real GDP growth to levels most people don't believe. We believe 7 to 8% in the next 5 years, driven by productivity. This is a wonderful world for equities. And when you say modern portfolio, I think we're talking about the modern world. The world we're about have entered with AI, the biggest catalyst, is going to transform completely. And we think that the other side of that is a disruption of the traditional world order, which we believe, from a private credit point of view, is more exposed. Equities to the upside, private credit to a disruption in the traditional world order.
Absolutely perfect place to end. Thank you, and on time. And over to you. It's like being in the school again, isn't it? Katie.
Great. Okay, so I'll hit on 3 attributes that I think are going to persist in terms of being attractive for credit as an asset class. The first one is that we think it will continue to provide ballast in portfolios. That didn't happen in 2022, but that was unusual because we had an equity sell-off during a very aggressive rate hike cycle. We don't see that in the next couple of years. We think likely the opposite. And so what you should get is, if there is a drawdown in equity markets, you should get support from your fixed income exposure. The second reason that credit's going to continue to play a very important role in portfolios all over the world is it has a high utility function. And what I mean by that is it is a great matching asset. For example, in insurance companies, it is a great matching asset for pension funds that are fully invested or on their way to being fully funded. And so credit performs an important function across a lot of institutional pools of capital as a matching asset. And then third and final, and where I'll spend most of the time of my 2 minutes, is in the fact that it is a increasingly very diverse bucket of assets with credit. So just remember, as credit people, all we're trying to do is get our money back. Equities upside, we can talk more about the differences of that, but in credit land, we loan people money and we get it back. Which means that we have to work a lot with the borrowers, which are, think about that as CFOs of companies all over the world. And what's happening is that the CFOs of those companies want much more flexible forms of financing. And because of this desire for more flexible forms of financing, some of which is to finance the projects that Kathy referred to in technology space, because they want these more flexible forms of financing, credit as an asset class is diversifying rapidly. So CFOs now, as borrowers, they want to be able to borrow against assets, that's securitized investing. They want to be able to borrow against cash flows, that's corporate credit investing. They want to be able to borrow in public markets. They want to be able to borrow in private markets. The same company can actually lend and have it rated both as IG and as high yield within the same company based on how it's being, in this case, the one I'm thinking of, how it's being securitized against IG assets. And so I'll just end that part by saying it's an enormously diverse sector. The CFOs want that flexible forms of capital, and that's a real advantage to those of you implementing that in your portfolio because you get a range of options from securitized to corporate, from IG to high yield. And then finally, if you don't underwrite it well in the private space, you're going to end up as an equity owner anyway when the credit doesn't work out, which is rescue finance, which we think is very attractive too.
Okay. Fantastic. Short statements. Very grateful. Two different arguments. I have a whole host of questions, but rather than come to me, what would you say to one another to push back on the other?
Well, actually, Katie and I know each other pretty well,
Yes.
and we compare notes, have done so recently, not even before this, the planning for this panel. And I guess from our point of view, given that all ARK Invest does is truly disruptive, technologically enabled innovation, we're looking at the deflationary effects of technology. And we know that the enemy of fixed income is deflation, especially if it's the bad kind, meaning not on the right side of change, but being disrupted by these new technologies. That does put assets at risk. They can become stranded. And it does put cash flows at risk. Katie, maybe you want we can go back and forth on that.
So you're saying deflationary?
Yes.
Yeah, I actually agree. I think that's, by the way, I think if people were coming here looking for a big fight between us, you're not going to get that today.
Someone wished me good luck. And I was saying, what?
I actually agree with a lot of that. I mean, I don't know how severe, I guess our outlook isn't that we're going to have a severe amount of near-term deflation. I just want to pick up on the innovation part because I do think that credit is part of the solution to how we're going to innovate. So just to give people a context on that, just to take AI for a second, I think we're both big believers in AI. Kathy could talk about it much more eloquently than I can. But we believe it's going to change the world as we manage both credit and equity. But our credit investors, too, also believe it's going to change the world a lot over the next 10 years. And we're going to have to make massive investments to fund AI. And to put that into numbers for people, the companies most likely to make these investments are the hyperscalers we all know in the US, the largest companies. They have not historically been really attractive companies from a debt perspective because they didn't issue debt. They didn't need to issue debt. They have an enormous amount of free cash flow. But now they're on the precipice of having to make these massive investments. And we should find out from Kathy if she thinks all of them are going to win. We don't. But they are forced to spend on AI because it's an existential threat to them. And they cannot fund all of it through their own free cash flow. So if there's $3 trillion going to be spent on data centers, you'll correct me on the numbers, but let's just say that's the number over the next 3 to 5 years, they're going to fund half of it through free cash flow. The other half they're going to have to come to the debt markets for. And we are stepping up and helping finance those projects. And just to take a data center, there's many ways that you can do the financing, but let's stick with data centers for a second. If we go and finance a data center, and the tenant is Meta, Google, Apple, Facebook, on a 10-year view, that's going to be an IG credit, I think. Now, whether or not the equity performs, because we don't think all these companies are going to be winners, but on a 10-year view, that you're taking IG credit risk in lending to this, and you can get a couple of excess points over IG. So that's an example of where the debt markets are going to need to step up and be part of the solution for facilitating AI.
Go.
And we agree. Those are cash fortresses. We would be more concerned about the companies that are going to be disrupted. So
Yeah.
I think this is a case both of us would be making for active management on the debt side, active management on the equity side as well. Our concern is the disruption is going to be across sectors.
Yeah.
And so even in the case of transportation, autonomous mobility, Warren Buffett is a big railroad fan. And those assets have been sterling assets for a couple of hundred years. We would be concerned about them because autonomous trucking is going to take the cost per ton mile down below rail. Rail right now is about 4 cents per ton mile, and autonomous trucking, according to our analysis, will be 3 cents per ton mile. What is going to happen to railroads as a credit, right?
Yeah.
Their fixed assets are going to be stranded if and we see this not only in transportation, but healthcare, manufacturing, retail. If you thought the internet disrupted retail, just wait until agentic assistants take us around the world shopping, especially here in Saudi.
So can I want to challenge both of you because, Kathy, there's an argument that, you talked about innovation and you kind of challenged Kathy a little bit on, but it doesn't always translate into profits, right? I mean, at the moment, the growth of the equity market in the the S&P 500, I said, that's driven by 7 tech stocks, right? And you talk about there being some significant failures, some are going to get disruptive. What happens if the tech stocks get disrupted? And then on your side, we've also seen some challenging credit situations, should we put it that way? First Brands being the obvious one that's been in the news. So what about the downside risk for both of you?
So I'll start and just say, the answer is back to active management.
Okay.
Having the right kind of research to point investors in the right direction and away. So pointing them to the right side of change, certainly on the equity. Now, just on the MAG 7 being the primary driver, in the last few years that was right. This year it is not. This year the market is broadening out as time horizons and risk appetite increase. And so it is benefiting more innovation sectors, even if they are not spewing cash flow. So it's been a very interesting year that way.
I want to ask you a question before I'll answer mine on risks. There are a lot. I'm happy to talk about them. But when you were talking about disruption, I'm just thinking about this from an investment thesis we have. Can you reflect for us a little bit on software and what you think could happen in that space? Because that has a lot of exposure in the private credit markets that we're nervous about, but I wanted to get you to reflect on that.
Yeah, it's so interesting seeing private equity and private credit move towards software, which again, very stable cash flow, high margins, very predictable, except it's going to be disrupted.
Yeah.
And so what we believe is happening, and this is an AI question, is everyone knows about chips, data centers, infrastructure. We think that is real spending and is going to deliver returns. What is going to happen to the other 2 parts of the tech stack, the platform as a service, so think Palantir. Palantir is the premier platform as a service company today. It is going to usurp the role of software as a service over time. What Palantir does is lay its software on top of all existing software.
Yeah.
And it's a little bit like a Trojan horse, right? It then goes in and usurps the role of all of that other software. So we've been watching SaaS very carefully. The growth rates have not really accelerated. Many people thought they were going to be the prime beneficiary. We think they have been losing share in the last 5 years in terms of incremental growth. We think they're going to lose a lot more share in the years going forward.
Yeah. And so on credit, you asked about a couple of high-profile challenges in the credit market. Yeah, and I think there'll be more. So like we believe that we're relatively late cycle, and on a credit perspective, spreads are at record tight. So you're actually not getting a huge amount of compensation for taking credit risk. The way that, I just want to pick up on the active management point, and I'm going to come back to software, but the way that we implement that at TCW is that we're 15% underweight credit in our public portfolios, and we're sitting on a lot of undeployed cash in our private portfolios. And on Liberation Day, when things sold off, we bought $6 billion of credit because spreads widened to their normal averages. We've since sold all of it because they've narrowed back. We think either the economy or governments around the world are going to give us another opportunity for volatility, and that eventually will close our credit exposure. We're offsetting it with deeply structured securitized positioning because obviously we're carrying a lot under index and peers by being underweight credit. But I do think that is my answer to you. We do think there are risks out there. To Kathy's pick up on her point, active management helps you avoid those by underwriting the risks and ideally being with the right securities. So we didn't have a large impact from those. And then in the private credit side, you obviously have covenants as a way to try and get your money back in those situations. So you want to lend to the right company and then have the right things in place to get your money back. I'm going to end with the risk on private credit. What has happened, we believe in private credit. We manage a lot of it. There has been a lot of optimistic lending. Kathy is allowed to be optimistic because the upside is infinite in equities. We don't get to be optimistic in debt lands because, again, we're just trying to get our money back. Lending the money is the easy part. Getting it back is the hard part. And when you do optimistic lending, that becomes challenging. And when you don't have covenants, which the asset class has given away, that is also challenging. And so if the interest rates stay higher, we don't think they're going to zero, these companies are suffering from an interest burden problem. If you get any hiccup in the economy, that's another challenge. And just to come back to software, in the private credit space, 30% of large sponsor private credit is to these software companies. And those loans, if you look up these BDCs, they've already started to be written down. That is an area of potential real risk in that asset class, that you have a combination of late cycle, relatively optimistic lending, and we've lent to a sector which Kathy so eloquently explained is going through massive disruption. And if I were you, that's an area I would watch for concern in private credit.
I'm going to give you both 30 seconds, no more than 30 seconds, to conclude your argument. Because at the moment, you're 50-50 in terms of what the polling is. So if you haven't poll, go on. Why should equity dominate the modern portfolio in 30 seconds?
If you believe we're in a technology revolution, with AI the biggest catalyst, what you need in a modern portfolio is exposure to this asset class, disruptive innovation, which we think is going to deliver over the next 5 years a compound annual rate of return of 50%. It's doing that this year, and we think it will continue. Credit, as Katie has so eloquently said, the returns there are linear and capped. The returns in equities are exponential.
Yeah. I think if you have an infinite time horizon for investing, you should put all your money with Kathy. That's a great idea, and ride the innovation up. I think the reality is that most people are judged on shorter time horizons. You have stakeholders that care about other time horizons. You may have liabilities that you need to match. So I continue to think that credit performs a very important function in portfolios, but I would never own it on its own. So I know that's not what we were supposed to do, but I actually think the answer is you really do need both of them in meaningful amounts of the portfolio.
And clearly everybody agrees with you because it's still 50-50. So you've both argued brilliantly, but neither of you won the battle. So thank you all very much. Will you join me in thanking the
That's what makes a market.